Tomorrow is the biggest inflation print of your life, and for those of you that don't know, CPI, or the Consumer Price Index, is an index that measures the monthly change of how much the government has screwed over the middle class and in turn benefited the 1%. And as a newly endowed member of the 1%, I think it's only my job to pay it forward and give those coming after me the game plan to get to the position where I am right now. And CPI is simply that, just a game. And if you have the game plan and you play to win, you can win. And it's simple. If inflation comes in hot, we shrug it off and call inflation last year's problem and we buy the dip. If inflation comes in cool, we proclaim the Fed is on target and we buy the dip. If inflation comes in line, as expected, we thank Jerome Powell for doing his job and we
buy the dip.
Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, guys, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. This is the daily heat map of the S&P 500. A lot of green after the data we got today. The only sector that was red was energy. We saw subdued price action in the defensive sector, but a lot of green today. You can't deny the flows. It was a bullish day. It really was. And when you have Google, Meta, Amazon, Tesla, Nvidia, AVGO, Microsoft, Apple, when you have all of these stocks participating and the broader sector as well, look at how green it is here. Look at infrastructure, look at software application. When you have the entire tech sector moving with the big names, you're going to see market momentum to the upside. And that's exactly what we saw today. The S&P 500 was up 1.68%. I believe the broader US market was up about the same. The best performing sector here was technology, and the worst performing sector obviously was energy. When we actually look at market flows, it was tech, it was communication services, it was consumer cyclicals or consumer discretionary. They were the real outperformers today, and really it was just the big boys. I mean, when you look at stuff like consumer cyclicals, you have Amazon, Tesla. Communication services, you have Google, Meta, Netflix. In the tech sector, you have Apple, Nvidia, Microsoft. The best performing sectors today, the big players in the S&P 500 today were the winners. They led the flows. Everything else did participate. Now we did see the defensive sectors right here put out gains too. Utilities up 0.59%, healthcare up 1.23%, and consumer defensives up 0.63%. And that just goes to show the actual flow of the market. In any case, you really should be seeing selling in these names. Instead, we saw selling out of the energy sector and go into everything else. But really, we know that when the market had pulled back 10%, there was a lot of cash on the sidelines, and now all of that money is going into equities. There's no rotation here. This is taking the cash you've built up over the last couple of weeks and putting it into the market. And we really saw a breadth thrust today. Great breadth across the board, even in smalls, mids, and large. Large caps were definitely the winners. There's no doubt about it. Large cap growth up 2.02%. Nvidia absolutely smashed it today, up 6%, 7, nearly 8% at one point, up 13% in the last 2 trading sessions. Insane for the last 3 trading sessions. But large core participated, large value, mid cap core, and even small caps. In fact, excluding large growth, small caps outperformed in almost every other factor segment. It's insanely bullish price action today. We want to see if it continues tomorrow, and I dare say if we get a cool CPI report, it might just continue. It seems like a lot's priced in right now, but we are still well off all-time highs. And it wasn't just the US, guys. Across the globe, we saw rallies in the futures markets. I mean, look at Asia. Asia was very green, excluding India. Australia too. And then we had South America, very green. North America, very green. And most of Europe was also green as well. It was a bullish day across the board. When you have money pouring into the markets, you're gonna have a green day. And all of this upbeat price action stemmed from the macro. The macro has been moving the market in the last 2 weeks. It's only fitting that it's also going to move the market to the upside. Now, the big thing that moved the market was PPI, but we also got very upbeat small business optimism. This is the NFIB Optimism Index. The median forecast was 91.5. The actual came in at 93. Very upbeat, some of the highest levels we've seen since 2022. But what really moved the market today was the PPI news. The Producer Price Index, or the inflation inflation that businesses pay. CPI is what we pay. PPI is what businesses pay. The PPI came in at 0.1% month over month. The expectation was 0.2%. Very cool figures. Now, core PPI came in a little bit hotter. The actual reported figure was 0.3. The forecast was 0.2. And then the PPI year-over-year figures was at 2.2. And then core at 3.3, but it doesn't show it. But the market figures for this was 2.3% for PPI and then 3.3% for the core figure. So even though the month over month figure came in slightly hotter than expected, if we actually look at the year over year figure, we came right in line with the forecast. And in that situation, equities are always going to rally because it has to do with the current economic regime we're in. You see, in the context of weaker macro that we got over the last 2 weeks, that is obviously going to impact GDP. And if GDP slows and then we have hotter than expected CPI, we enter this environment right here, stagflation, or in worst case, GDP falls, CPI falls, we just enter a period of deflation. In both instances, in both these instances right here, stocks don't do very well, and particularly in stagflation, stocks just don't fare well at all. Stocks do best here in the expansion phase, in the inflation phase. They can do well in the deflation component of the market. But when we have stuff like slowing GDP and inflation increasing, credit quality deteriorates, credit spreads widen, it's risk off. You don't want to own equities in that type of environment, and that's what we saw today. CPI is not rising, CPI is falling or bottoming out. And while we didn't get the CPI reports, we get that tomorrow. We got the PPI. You can see that inflation is not rising, inflation is actually falling and bottoming out. And with some of the more positive data points we got last week with stuff like initial jobless claims, GDP at the very least won't be slowing or falling, and that means we're still in these regimes right here, expansion, inflation. Now, there are a couple of other regimes. This is a very toned down one, but it's good just to look at this and see where we are in the economic cycle. We don't want this, and we're probably somewhere in the middle right here. This is where we are right now. A lot's going to be dependent on tomorrow's CPI print, but let's dive into the S&P 500. And today was a sea of green across all markets. Look at the S&P 500 up 1.69%, the Nasdaq 2.5%, the IWM up 1.65%. It was a crazy day in the market. Mid caps up 1.3% as well. S&P 600 gained about the same. Growth outperformed value. But that's not to say value was lackluster, up 0.91% on the day. You take those gains any day of the week. Yields actually did fall significantly. They were down about 1.6%, and as a result, bonds gained. The TLT was up 70 basis points. And when it's risk on, the dollar's going to fall. The dollar was down 0.5 percentage point. That's a big move for the DXY. And on any risk on day, Bitcoin is going to do really, really well. It was up 2%. Commodities, gold, silver, and crude giving some back on the day after yesterday's big gains. But the S&P 500, not a lot happened in the gamma chart, and I think that's because we're going to see a big move in the put support or resistance as well as the gamma flip zones later today. What we did see was the put support moved up to 5,300, and that was about it. The gamma flip is still at 5,350, and the core resistance still here at 5,445, which means this is our upside target right now. And if this doesn't move up, we actually can see a little bit of downside if we do get there and the core resistance doesn't move up. If we do see this downside from the core resistance, our target will then be the 5,350 or wherever the gamma flip repositions itself. But I think that tomorrow we're probably going to see the core resistance move up to this level right here, the 5,550 zone, so up another 100 points. And then I think we're going to see the gamma flip probably move to where core resistance is right now, somewhere around there. Then it's going to be the job of the market to go ahead, retake this gamma flip tomorrow, and then our next upside target will be 5,550. That is if that happens. If it doesn't, we're probably just going to balance in this zone right here for the rest of the week. But if that move up does happen, expect us to continue the momentum, especially on a cool CPI report. Now, it is dependent on CPI. PPI and CPI are not super correlated, and if the gamma flip doesn't move up, tomorrow's CPI can most definitely be a sell news event after today's rally. But it's all going to be dependent on the print. Remember last CPI print, CPI came in a little bit hot, but the PPI came in cool, and then the market rallied on the back of the PPI, or found a bottom on the back of the PPI. That was around about here at this point right here. We were struggling with inflation, and the cool PPI propelled us to all-time highs and then started the meltdown lower. Big things tomorrow. Watch what happens with the gamma tape, and then watch the CPI report. That's really what you want to look for tomorrow. Specifically the CPI report. If you don't have access to the gamma data, just watch the CPI report. Okay, if it's cool, it's good. If it's hot, not going to be good for the markets, particularly CPI. CPI is far more important than PPI. But very interesting things to look right now, guys. If you go on a year-to-date chart, right, the Nasdaq literally went from down 2% on the year at this trough low to up 12% for the year. And if we actually measure the Nasdaq 100 from a peak to trough basis, we are officially out of correction territory. That is absolutely wild. I mean, from the lows right here to there, 9% rally in 7 trading sessions, a week and a half, we had a 9% rally. This is why I said, you guys, buy the dip. Every 10% pullback, you want to buy the dip. And had you bought right here, I was buying a lot of for my ETF portfolio at this lows right here. I was buying the ticker QSML as well as the ticker NDQ, which is a Nasdaq 100 ETF. It's literally the exact same thing to the QQQ. I bought a ton of Nasdaq 100 right here, and I think we're going back to all-time highs. Nvidia is showing exceptional strength, but we're also seeing strength in the broader market stuff like the RSP, which, by the way, not too far off all-time highs. That looks so messy. Let's remove these drawings. Not too far off from all-time highs. I mean, 3% from all-time highs for the equal weight basket. Nuts when you think about it. And then we look at the IWM. I think we're going to see these 52-week highs again sometime this year. Without question, I think we're going to see, the IWM get to, what is it, 220 level if we go regular. Yeah, the 225 as high as 230 level. Right now we're sitting at the 207 level. This has always been the level that's kind of annoyed the IWM, but the second we get above it, right, we break above, find support, you can have a huge rally up back to these 52-week highs and even new all-time highs. I'm still bullish on small caps, by the way, guys, but small cap quality, not the IWM, not the SP600. Look at the CAF index, look at something like QSML, XSHQ. That's a mouthful to say. Yeah, for the S&P 500 tomorrow, we're in positive gamma, so you want to be buyers of dips, sellers of rips. But if this doesn't move up, guys, we want to look to the downside. We're going to see 5350 come into view if the core resistance doesn't move up. If it does move up, we just trade that higher level in positive gamma, assuming that we are in positive gamma tomorrow if the gamma flip does move up. Now, guys, looking at sentiment, we have Goldman Sachs sentiment indicator, and we have seen a steady decline in sentiment over the last couple of weeks, finishing where we are right now here at 0.7. And pretty much sentiment is no more in stretch positioning, but it's not in light positioning either. And what Goldman Sachs indicator is telling us is that it's time to buy the dip, but also time to be cautious, because if this continues to move down over the next couple of weeks, then things can get ugly. And at the end of the day, market pullbacks simply are opportunities, especially in bullish years. After a return greater than 10% from January to July, accompanied by a pullback in the first 2 weeks of August, and what we often see is that August 14th to August 31st, so the last 2 weeks of August, tend to be negative 0.53%, but the following months tend to be quite bullish. From September all the way into the end of January, we tend to see very upbeat returns, 1.8% all the way to as high as 3.67% here in the month of November, culminating in the full forward performance from August 14th all the way into the end of January, 9.34%. Very solid 6 months of trade, 14 wins, 2 losses, a very strong hit rate. And that is why I say you want to buy the dip. But we actually have to be cautious well into September up to October 2nd. This is a time period where we can actually have a negative return, negative 0.9%, 6 wins, 10 losses in this time period right here. So essentially what this data set is telling us is that when we get market volatility in a heavy up year, we can actually see sideways action through to as late as October, but November, December, and January tend to be very, very bullish, and you do want to remain bullish after a 10% year run, because momentum brings momentum. And even in an election year, this time period right here, the July, August, and September time period, tend to be a fairly tumultuous time. We actually kind of just trade sideways in this 3-month period of the year, and this is actually what we've seen in the S&P 500. While we haven't really been trading sideways, what we have seen is, downside, a bit of a pullback. And if we are to par a lot of these gains, essentially what we will have done is just trade sideways in the S&P 500 in typical historical fashion. What we do want to look to, though, is that from September, October, November into December is that we normally see substantial returns. And you don't actually want to look at the level of returns, you actually want to look at the trend. And the trend into the end of the year is up. Seasonal data supports that, historical data supports that, and that's why you want to buy the dip in this type of market correction right here. This is actually a gift considering how the year tends to play out during election years. But all of this is smoke and mirrors. At the end of the day, what really matters is valuation and earnings. And earnings for the S&P 500 has come out very, very good. This is the earnings surprise factor. You can see earnings has surprised 4.5% to the upside, with utilities being the best sector, technology being the worst, but still up 2.6%. And this obviously goes to show the fundamental backing of the market. But what does it actually mean for valuation of the US market? According to Morningstar, the US market is currently 2% undervalued. We were about 4% undervalued at the end of last week. And this is an opportunity to get long. Why? Because normally when we do get periods of undervaluation like we did here, here, and here, at the end of the day, we normally par all of those losses and end up in the overvalued territory. So it is a good time to get long. But this is the entire US market. Let's break it down into factor and size segments. And what we can see right here is that US large core as well as growth are actually a little bit overvalued. In fact, large core significantly overvalued. Large cap growth and mid cap growth, I would say, are fairly valued. And then the rest of the factor and size spectrum appear materially undervalued. Look at small cap value, small cap core, and small cap growth. Anywhere from 8 to 18% undervalued. This right here is simply opportunity when the re-rating comes. This is part of the reason why I've been so bullish on small caps, but not small caps as a whole, small cap quality. We also see material undervaluation here in the mid cap value and core segments, as well as large cap value, 2.1% undervalued. And if the size and factor rotation broadens out in the way I think it is, it's very easy to see where the opportunities are. And guys, looking at earnings, there wasn't a lot to go off today. We had NU, they were up about 6-7% in the after hours. I guess the market liked their earnings. I didn't dive into it. C was up 11.85%. They beat on both the top line and the bottom line. Home Depot also had a double beat. They beat sales and EPS expectations. However, the stock was down about 4% in the pre-market on these earnings because comparable sales were down, and they also lowered their guidance. I think they were guiding for 3 to 4%. They're now guiding for 2 to 3%. But the market was so strong today. Home Depot actually finished today up 1%, 5% off its lows. Kind of crazy when you see market momentum trump fundamentals. But at the end of the day, it'll always come back to the fundamentals. So if you see Home Depot sort of having lackluster returns from now into the next quarter relative to other similar stocks in its sector, don't be surprised. Now, looking at some macro, we got some very interesting commentary here from Goldman. They say third quarter GDP, they're tracking at 2.6% right now. This is where it gets very, very interesting, right? They say solid final demand growth is one reason why we expect demand for workers to hold up and prevent significant further deterioration in the labor market. We expect state and local government spending growth to slow in the back half of 2024 to a 1% annual pace, much less than the sharp declines in proposed budget suggests. Most of the increase in our financial conditions index after the July employment report has now reversed, and the FCI impulse to growth remains positive. We estimate that every further 10% sell-off in equities would reduce GDP growth over the next year by about 45 basis points. This rises to 85 basis points if we include the move in other asset classes that usually accompany equity market sell-offs when growth fears arise. From a starting GDP growth pace of over 2%, this means that it would likely take a larger, further sell-off to single-handedly push the economy into a recession. Our new financial stress index, which captures the signs of disruption to market functioning, has tightened but remains at a historically normal level. So pretty much Goldman don't see a recession, and they do see spending to actually be a lot better in the second half compared to what a lot of budgets were suggesting. Financial conditions have eased and we're tracking robust growth for the third quarter. It seems very upbeat despite all the negativity we've seen. And something else that's been upbeat in the data lately is the small business optimism index. We saw pretty much pessimism here at the start of 2024. We have since seen small business optimism move up and up in a very big way. In fact, this is some of the highest levels we saw since 2022. You have to understand that 2022 2021, start of 2022, small business optimism was at some of the highest levels ever. So to see this is very, very constructive for the economy, because we do know that a large part of the economy is dependent on small businesses. Data tomorrow, we have CPI, the big one. The expectations for core CPI and headline month over month is 0.2%. That is the consensus figures. And then the year over year figures is 3% for headline and then core at 3.2%. So tomorrow, all eyes will be on CPI. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.